commodity pricing, which that is one of the unknowns because it fluctuates on a daily basis. The great thing about it is it doesn't stay there. So if oil prices drop to $30 again, they're not going to stay there. They're going to come up. If they go up to $100, they're not going to stay there. They're going to come down. So that's the one unknown. Mother Nature and commodity prices, those are your main risks the way we design these wells.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Mr. John Engel, thank you so much for being on the show. This is Path to Passive Real Estate Investing for Tech Professionals, as you know. And I'm really excited to bring a guest on like yourself, expert in oil and gas, energy, to come on and talk to us about this topic. There's a lot of stuff out there, a lot of marketing, a lot of, invest in oil and gas and get all of the tax benefits, right? But I think with many of the listeners on this show, they may not know a lot about this topic. You're actually one of the first person on our 100 and almost 15 episodes to come on and talk about oil and gas. And it's mostly because, there were other, I wanted to state in some of the main competency I've had, which was really, real estate from the traditional types of assets. But oil and gas and oil is so cool. And I'm glad to have you on here to talk about what it can look like from a cash flow perspective, as well as all of the truth that you can talk to us about for the tax benefits as well. So please, warm welcome to you. Please introduce yourself and then we'll dive in.
Well, thank you for having me, Stephen. My name is John Engel. I'm the COO of Gulf Coast Western. We're a Dallas-based energy firm, been in business since 1970. Since 2007, we've been putting together general partnership joint ventures for our partners to participate in our oil and gas wells. There's numerous benefits to it. Number one is, like Stephen was just saying, cash flow. We deposit based on how the oil wells that are in each partnership perform. We deposit cash flow directly from those oil wells directly into our partners' bank accounts via ACH or direct deposit. So that's on a monthly basis. And all we're really doing is a kind of a micro strategy of what the big players in the world do. They raise money by selling ownership in their company through stock sales. They take that capital that they raise from those stock sales and go out and drill oil wells with it. If you're in a good public company, you might be getting quarterly dividends if those companies are being run right. Other than that, you really don't get cash flow other than in the form of quarterly dividends. You also don't get the tax advantages that those companies are receiving by drilling those oil wells. The company is using those. So what we do is we raise capital to go out and drill oil wells just like they do, but we're not selling ownership in our company. We're selling interest in the wells that we're participating in. By doing so, we're able to pass on the intangible drilling costs, intangible completion costs, and the depletion allowance that comes from each barrel of oil, which is 15% tax-free income from every dollar that's received from an oil well. So we package up a certain number of wells, and let's just say nine wells up to 100 wells. And then those wells, when they go into production, whatever that partner invested in proportionately, they get that same proportionate share of the revenues from all of those oil wells direct deposited in their account. So it's very similar to real estate in that regard. It's the operator does all the work. You're not having to go out and put a new roof on a home or anything like that. We're not asking our partners to go out there and stand on the rig. It's dangerous, and we let the professionals do that. But it's like having a property management company that is very well run, puts the occupants in, those occupants pay, and then you get those rental revenues direct deposited into your account. It's the same thing, except your renters are the oil wells and the oil that comes from it. So it's a pretty simple business model. It's very complicated behind the scenes, but we make it. We only our clientele are wealthy, sophisticated, accredited investors that have high needs for tax deductions. They're almost all in one of the highest tax brackets. A lot of them live in the high tax bracket states, California. Um, and so they get to benefit from that and get some of that money that was going to the government, no matter what, and they get to get a little bit of that back in the form of tax deductions. But more importantly, they get to see monthly cash flow into their accounts from these oil wells.
Nice. I know you had this. I know being from Texas, you had to sneak California in there, but everything else.
I love California. I don't know how I could not work for a government until July, like they do in California, before I start making money for myself. But beautiful, beautiful state.
Absolutely.
Other than their taxes.
So you just gave a really big picture of the business model, all the way from how, you package it. I think you said like 9 to 100 of them. You raise the capital to go and fund like putting them together, to have the professionals, the operators there, the people on the ground, the boots on the ground actually do all of that work, so that the capital partners, the people that your investors, actually get their monthly returns as well. And you mentioned things like intangible costs, like drilling costs. Those are some of the things that helped with the tax, the breaks as well. And I want to talk about that. But I think one of the first things that is also really important to baseline on is, John, like oil and gas. Great. I've seen this stuff. It makes a lot of sense. There's stuff in the ground. When you get the stuff in the ground and we bring it up, and we use it, right? But what about this alternative energy thing? Our listeners are like, they've been hearing this for a long time now, for decades, right? Sustainability is top of mind, especially for many tech professionals. Heck, I work in, cloud best practices, right? And we're all about we have sustainability best practices and stuff too. So tell me about the industry of energy. Tell me about the need for oil and gas here.
Well, that's a great question. And to put it bluntly, it's the most important commodity we have on the planet. Oil and gas is a naturally occurring substance. It's constantly replenishing itself, so it itself is renewable. The oil that we're producing today was put there by Mother Nature millions of years ago. In most cases, most of your big oil plays were at one time the bottom of the ocean. That's where life deposits on itself over and over, or mangroves, or like the Great Barrier Reef or the Everglades. In millions of years will be great, oil reservoirs. We won't see that, but that's kind of how they develop, these big pockets of oil. And so, but from that, we use oil to fuel our cars and fuel our country with natural gas. Our wells generate both oil and natural gas. It is, but of a 42-gallon barrel of oil, only 19% of that goes to making gasoline. The rest goes into making every single thing that we use on a daily basis. There's over 6,000 products that are made from a barrel of oil. You use them and you don't even know it. So I am all for alternative energy. I'm a big proponent of nuclear energy, as long as we don't put them in earthquake zones or tsunami zones. Because that is the cleanest energy there is to fuel a city. I like Teslas. They're fun to drive. You can't build a Tesla, though, without plastics. You can't get the batteries from overseas without fuel oil. So until they start making, electric ships that can, deliver hundreds of millions of tons of goods, we're going to be using oil for quite some time. And you think about farming, think about feeding the world. There's not a whole lot of Tesla tractors out there plowing the field. So it is here to stay. We need it on a daily basis. Like I said, the most important commodity in the world. Before oil and gas took over, we lit our homes with whale oil. So the whales love the oil industry. They told us. But no, it's a very important commodity. If we didn't have it, we'd be living in caves and burning wood, to heat our homes. And with 6 to 8 billion people, whatever number you want to use, that's not sustainable.
Yeah. What are some of you mentioned, I'd love, kind of curious, what are some of the things those 6,000, products that still use oil, and what are some of those 6,000 things that you can name that, people might not even realize that require oil to be produced?
The monitor you're looking at right now, the camera you're looking that's filming you right now, every bit of plastic, a lot of your medicines, your clothes, your just getting things to market. But literally anything made of plastic, which is just about everything these days, is made from oil. Um, your shingles, your Occidental did a great video years ago where they stripped a house of everything that oil that was oil related, and it pretty much brought it down to just the timber frame. And then
Wow.
you wouldn't even get that to the home site without oil and gas. So it's literally in everything: your makeups, your medicines, your a lot of your just it. It's there's so many that come to mind, but I mean, I wouldn't have half of the stuff in this office without oil and gas. But
Got it.
it's literally
And
everything, your cell phones, your computers, everything.
And I forget the exact stats, but I remember seeing it. I always remember it's still like 90% of the world still is using something that is based on oil. I mean, of course, all those products, but in other words, the alternative fuels is like 10% or something, right?
Yeah, that's about right. And again, you need. I like wind power. I think it's ugly for the environment and it kills a lot of birds. But I like the idea of it, clean energy. I
hmm
like solar energy. Again, doesn't get much cleaner. It's not super efficient yet, but you can't make a solar panel without oil and gas either. It's
Yeah.
all hand in hand. That's why I like nuclear the most, is because it generates a ton of power, and it's ultra clean as long as nothing bad happens. But they've got that pretty well down to a science too now.
Yeah. So the here to stay is definitely here to stay with 90%, a huge chunk of the world still needing it, and all these other, as people, the royal we, continue to develop tech that can be better. I know there's like small form factor, smaller modular stuff for nuclear, what you're talking about, and some of these other types of quote unquote alternative energies that are getting better and better. We're going to be needing this for at least a couple full investment cycles is kind of the point, right?
Absolutely. Yeah. It's if you just look at the world economies, all of your developed nations, all of the nations with the highest, level of quality of life, they have the most energy and the most abundant
Yeah.
energy and the cheapest energy. The ones that don't are the ones that are struggling and are still third world countries. It is a simple fact that energy runs the world, and we produce a lot of it here. And so part of what I was getting at earlier is we can go out. The government wrote this into the tax code 100 years ago, that if you're going to go out and help develop our natural resources and power our country and take the risk to do that, they're going to give you some tax incentives.
hmm
We could go out and we could drill a dry hole in the parking lot, and I would be able to write that off because I took a risk in trying to find the next pocket of oil in the country. The government gives us that. But the government, if I go out and I drill the best well in the country, I still get that same tax advantage because I still took that risk. So the tax
hmm
deduction applies whether you're out exploring for oil or whether you're drilling in the best field in the country, and it's a sure thing. So we focus on field development projects where we're drilling in areas with known production, proven reserves, and then we operate our wells with the best operators in the country. You pick a name and we worked with them. They run our wells. We pay our proportionate share to drill those wells, but we rely on their multi-billion-dollar budgets, their teams of engineers and petrophysicists to find and design these wells so that they all work.
Cool. So that's a key shift as well. And I like the, whether it's in the parking lot just nearby and, or where we know, I forget exactly how you said that, but where it's proven to have oil, the cost for drilling is where some of those tax benefits actually come from. Now, let's focus. So the energy industry, oil and gas, is here to stay, right? We established that. We talk about the need for it in all of our our vehicles, our homes, the monitors we work on, and how populations like ours, as the nations, the places where are the most modern, are going to continue to need more and more energy, and that demand is just going to grow too, right? As we get more tech, let's face it, AI, et cetera. But talk to us a little bit about what the model looks like. I mean, again, big picture, it's like, okay, we have to have everyone's seen some kind of picture of an oil pump, right? But from the start to finish, what does that actually look like? And I'd like you to start off with just talking about there's different stages of projects. We don't need to go super deep into those, but you talked about knowing where it's been proven that there is oil already, right? Versus what things are like exploratory and some other stuff, right?
So if you ever hear the term wildcatting, that is going out and exploring for oil. It usually involves 3D seismic, which bounces, sound waves off of different rock. And if they get a return, it's either going to be water or oil. You have to drill the well to find out which one it is. So in that case, the geologist is looking at, are there other areas in the nearby that these wells produced from at that same interval or that same depth? So if they produced oil, chances are that's still going to be oil because it's the same depth. That's not always the case though, because again, if you look back at where all this oil comes from, at one time it was the bottom of an ocean or a shallow sea. So in some cases, that reservoir you're drilling into, while you may think it's oil because 600 yards away, that same reservoir produced oil, it could be saltwater, 12,000 feet down. So what we do, and we've done our fair share of wildcatting, and we don't do it anymore. So now what we do is we've shifted to, like I was just saying, the field development, where it's proven reserves are. So just using the field north of Denver called Wattenberg Oil Field. Now, if you've ever flown into the Denver airport, I don't care if you're coming in from the south or the north, look down and there are thousands and thousands of horizontal oil wells below you. That is a proven field. It was put there in the middle of Colorado 93 million years ago. It was the bottom of the Great Inland Seaway. That Great Inland Seaway in that particular area deposited tons of life on top of itself. And so there's huge carbon deposits there. That's what we're going after. It's roughly 1.5 miles below the surface of the earth that we're drilling down to. And because it's laid down a big blanket reservoir. So right now it's approximately 2,000 square miles of blanket reservoir. It is perfectly suited for drilling down and then horizontally, instead of just drilling vertically through a reservoir this thick, I'm able to drill down and go 2 miles laterally and put that much more oil, that much more pipe in the oil, and therefore my wells work that much better. So from start to finish, what I'm looking for, if I get a prospect sent to me, I'm looking at what the wells in the area are. There other wells that produced? That's number one. In essence, if I was a gold miner, I would continue to mine where I know the gold is already at, instead of going across the valley and digging an entirely new mine shaft, hoping I find something.
Yeah, and by prospect, you mean like a prospect area?
A prospect is an undrilled oil well. The operator says we're going to drill 10 wells or 14 wells from this particular location. Those are prospects until they're drilled. So what will happen is if I look and I see what the wells in the surrounding area have done, I can look and see exactly through state records how much oil was produced on a daily basis. If I like those numbers and I like the operator and I know that those wells are going to be run efficiently and cost effectively, I will I will sign on and we will drill those wells with them. So what happens from that point is the state issues a permit. The permit specifies where those wells can be drilled, what reservoir they're going after, how deep they can go, and the lateral length. Then they will, once all of that is approved by the state, the operator will come out and clear the pad. It's usually about a 5-acre pad on some farmer's land. It's mostly wheat fields up there in ag country. So the farmer lets them know, you can clear 5 acres of my land here, so it's not bothering any of the rest of his land. And from there, they'll order the drilling rig will show up. The drilling rig comes in, and it is only there while the drilling operation takes place. So just say it's a 14-well pad. That rig will show up. It'll drill all 14 wells in rapid succession, like an assembly line. As soon as the drilling is complete, they move off, and then the completion crew comes in, and they're the ones who come in and poke holes in the pipe and get the well to start flowing oil. So once it's in production, it's flowing directly into the tanks and the pipelines that are already in place, because this field already has thousands of wells that are already producing. So all of those are factors that I look at before we commit to a project. The nice thing about that Wattenberg field is it's been there since the 70s, but the horizontal drilling only started taking place in 2011. So all the infrastructure's there. All the workers live there. They drink the water. They breathe the air. Their kids go to school there. So everybody has a vested interest in these things working efficiently and cleanly for the environment.
And clean. Ton of good stuff. Let's drill down into what you were talking about with you said like 20,000 acres is where that whole basin where there could be oil, but there's like 5-acre patches of where the drilling is actually done.
That's 2,000 square miles. Maybe you could spend a day out there just driving from one end to the other. It's massive. It looks small on a map, because it's basically everything north of Denver. But so most of these wells are on a 2 to 4 square mile lease. And so from one 5-acre pad on the surface, by putting multiple well bores down in the reservoir, it looks kind of like cornrows the way they're laid out. They can cover 4 to 8 square miles of reservoir from one 5-acre pad. It's
wow.
Amazing technology. They space these wells out to optimize how much oil can be taken from each well bore without pulling oil from the other. Because you want each well bore to be able to pull the maximum amount of oil for what the drilling costs were. So, and that's where we leave it to the engineers and their expertise. And I don't have to talk to a geologist. I don't have a geologist on staff, because what is my one geologist going to say to an Occidental or a Chevron or an Apache or a ConocoPhillips team of engineers and petrophysicists and geologists? Nothing. Yeah. So I look at it and I say, I like the production in the area. If they're drilling into the same rock using newer technology, because drilling technology improves just like your tech technology, your iPhone, your all electronics are constantly being updated. The same thing is happening in the oil industry. So if I like the operator has a good track record, they're drilling into the same reservoir using the same but better technology, I expect the same, if not better results than the wells that produced around it. So that's
for sure.
That's really what I look at. And, I haven't talked to a geologist since our last wildcatting expedition. It wasn't very good. But I haven't drilled a hole. I haven't drilled a dry hole in the same time frame. So in 7 years, I haven't talked to a geologist, and I've drilled over 400 wells without a dry hole. So I'll take that.
Very nice. Yeah, definitely. You can focus on, value add other places, certainly.
Making our partners money. That's our main goal.
And providing necessary energy to our nation.
Well, let's get paid to do it.
Yes. So you said that the infrastructure that's been there in this particular area, you said Wattenberg Basin, is that correct?
Wattenberg Field, yeah. It's part of the DJ Basin field. Is the the larger basin, which extends all the way into Nebraska. But this field we're in is a concentrated, like I said, blanket reservoir where we're not. There's parts of the DJ where you can go exploring for oil, but we don't drill there. So we're focused on the Wattenberg. We also have wells in the Permian Basin and the Powder River Basin. But I like the Wattenberg because of the economics. The wells are, I won't call them cheap whatsoever, but they're economical compared to other areas of the country, and your infrastructure is already in place.
Cool. So that's what I was going to ask about. So you said infrastructure has been there since the 70s. And, you have this huge plot of land. I don't know, plot is even a fair assessment, but you have this huge landmass, right? Surface area and huge area. And you have these pads that are put down. This is where the drilling is done, where the wells are. And you were talking about that infrastructure going in the 70s, but then new tech coming out in 2011 as well. And I mean, the key takeaway that I want to ask here is, okay, so an oil well goes in, like how long does this thing produce? And is my first part, and if I'm an investor, because obviously I'm learning about this to invest, it's what does the hold period look like, the investment amount of time look like as well? So, and how do those match?
Great question. So when you invest in an oil well or oil wells, again, our packages of wells, we don't do one well deals, because if there's an underperformer on a pad, we want to make sure that it's all averaged out. So on any given pad, there could be a well that is an overachiever, and there will be one that is an underperformer. So we put multiple wells in a package so that it's all blended together and you wouldn't notice anyway. We do provide the production reports, but just in case there's an underperformer, the overachiever, evens everything out for everybody. So, but the way it works is a well goes online. So when the crews move off, they turn the wells into flowback. They're offloading water at first, and then the wells will start to generate oil and gas. The first day that well generates oil and gas, that oil and gas is sold, a ticket's created and logged, because the state is also watching every barrel of oil and every MCF of gas that comes out of a well, because they get their tax revenue from it. So everything's monitored remotely. They also have field personnel that go out and check on them every day. From a timing perspective, now what I want you to understand is this is not a liquid investment. It's not a stock. So you can't just tomorrow decide you want to sell your interest in these wells. You can offer it to your other partners that are in that project. But as far as it being a liquid asset, it's not liquid in the sense that you can just, sell it tomorrow for a profit, buy low, sell high. Does not work in this, because
right.
The money you invested went into drilling a bunch of holes in the ground and putting a bunch of production equipment on the surface to produce the oil that comes out of the ground. So in the way of oil and gas, it is liquid. But that your revenue source is what is produced out of those wells. You do get on April 15th, when you're writing out, when your accountant says, here's your tax bill, you will see a significant amount based on your tax bracket that you save from going to the government. So I look at it as that's your first revenue distribution right there, is from the government by way of tax savings. When the wells go into production, oil sells on about a 60-day time frame. And then your gas contracts are paid on about a 90-day time frame. So once on the fourth month, we're paying our partners on the fourth month after that well goes into production, and then it's every month afterward, because it's got that first 4-month period. In Colorado, they give the operators up to 6 months to make that first revenue distribution, but it usually includes 2 or 3 months of production so that they can get caught up on all the signatures that have to get done on those first oil sales. But every month from there on out, we deposit whatever your proportionate share of those oil wells, and we deposit that on the 20th of every month to our partners. Now, the way oil wells work is the oil in the ground is a depleting asset. You've drilled holes, you're going to get oil and gas out of it, but that oil and gas is depleting the second you start producing it. it's not going to last forever. And so that's where that 15% tax free or the depletion allowance comes in, because it's not going to last forever. The government gives you a depletion allowance where 15 cents of every dollar is tax free because of that depletion allowance. So if your well generates $1 million in revenue over time, you see $150,000 of tax free revenue from those oil wells. These wells in Wattenberg Field are estimated to last decades. The bulk of your returns will come in the first 5 to 7 years, and then but they'll produce at an economic level for up to, some operators even put up to 25 years economically on these wells, because they're putting anywhere from 2 to 4 miles of pipe in the oil. So they're gonna, in some cases, can become an heirloom asset. My CEO's father drilled wells in New Mexico that are still back in the 70s that are still sending revenue distributions. So
what is that?
Go ahead.
So that's interesting though, because the first 5 to 7 years is when you're going to get the bulk, right? Is what you said, or is what I heard.
Yeah.
And then the 9 to 20 or 25 would be less, but like how much less? And obviously, we don't have the crystal ball to know how much is in every place, which is why you're talking about even in a field, you'd have one that is, one lower performer, one higher performer. But again, from my investor perspective, I'm thinking like, okay, well, how do I know this thing is going to produce? And if it's illiquid, like what happens at, do I only have to invest for 3 years or 5 years so I get the bulk, or why would I? You see what I mean? I'm trying to understand.
No, so on these particular wells, the way they come online, so in a normal oil well, the day you turn that well on, you're going to have a depletion. Your decline curve is going to start that day, because that first day of production is when your pressures are the greatest. Again, a lot of these reservoirs are 7 to 10,000 feet below us. The pressures are immense, and they're pushing that oil up to the surface. From day one, your decline curve starts, and don't let anybody tell you otherwise. Every single oil well on the planet has a decline curve. The way these wells work is kind of unique, because when they pull the water off of the formation, they use water to open up the rock to allow the oil and gas to flow. When they pull that water off, you'll see on these wells anywhere from a 3 to 6 month incline curve, and then it'll plateau. And that plateau can last anywhere from a month to 6 months in some cases. So your decline curve on these wells starts usually about 6 to 7 months after the well went online, and it's declining from a peak, not from day one. So your decline curve starts up here. So you're really only noticing your decline curve maybe, in some cases 7 to 9 months after your well went online, where in other cases your decline curve starts day one. So from there, it's going to decline. Let's say your well was doing 1,000 barrels at its peak. It's going to decline over the next few months. But most of these wells equalize between 100 and 200 barrels a day and stay at a nice flat rate for a long time. You mentioned early on in when we were talking earlier about the pump jacks. Where we're drilling, most of these wells operate under their own pressures for a long, long time. There's not very many pump jacks in this field whatsoever. They run the driving mechanism on these reservoirs is natural gas, and that natural gas is pressurized and it's pushing the oil to the surface for us. So we don't have to put them on any kind of artificial lift for quite some time. When we do have to put them on artificial lift, which is just adding pressure to the reservoir to bring it to the surface, what that usually entails is just taking some of the produced natural gas, compressing it through a compressor, and sending it back down to the end, so that pressurized gas can just continue to push the fluids up. Because what you have to imagine,
so what is
go ahead.
Super interesting, and I want to talk about the natural gas part if we have time here too. But I am trying to get to the understanding of, you're giving an example of the first 5 to 7 years would be the bulk of it, right? And like you're talking about, it can still produce, and there's methods such as the compression of gas to bring more up. Right. But the point of every well has a decline curve, and And so it will be depleting over time, means that I'm trying to understand like what is the return structure look like? Sure, monthly, but should I invest once and just have it in that money, that principal invested for 20 years?
Yeah, so it is invested for 20 years. So, but the way it's designed, I designed these programs so that based on commodity pricing, which that is one of the unknowns because it fluctuates on a daily basis. The great thing about it is it doesn't stay there. So if oil prices drop to $30 again, they're not going to stay there. They're going to come up. If they go up to $100, they're not going to stay there. They're going to come down. So that's the one unknown. Mother Nature and commodity prices, those are your main risks the way we design these wells. Based on what I believe the commodity prices should be in that realm that we're in right now, we're kind of range bound in the $60 to $80 range. The way these are designed is based on how they produce historically in the field. We try to get our partners their money back, not counting the tax advantages, in the first 18 to 24 months. You
Principal.
Yeah, get you paid back, and then from there on, we have some projects that have paid out in the first eight monthly distributions, and then they've been in profit mode ever since for the last 4 years.
Got it.
It doesn't always work that way, but that's how I would love for all of them to work. But I designed them so that the partners are, they're getting a tax deduction based on whatever their tax bracket is. In some cases, you could be saving 50% of the investment right up front by way of tax deduction if you live in a high tax state. But leaving that out of it, I try to design them so they have a high double-digit annualized return and anywhere from a 4 to 7 to 1 overall return over time based on how much oil's in the ground.
Got it. So
wanted to sell it, like I was saying earlier, there's not like a market for a unit in one of the joint ventures, other than through if you wanted to go to one of your other partners and say, or we could put it out there for you, hey, partner Y wants to sell their interest. They have a unit in this project. You decide what you want to pay, or you guys negotiate it between yourselves. We don't create the market. But we will let, you can let your other partners know. But in that regard, if you're getting monthly revenue distributions that, why would you want to sell it? And if it's not generating any monthly revenues, no one's going to want to buy it. So, it's just, that's where I say it's pretty much when you're in, but most of these, again, are designed for a relatively short payback so that you're made whole quickly, not counting the tax deductions that you save from going to the government, and then for years and years to come, and again, we're going to follow the directives of a will or an executor should someone die, but we can put them in family trust. You can put them in IRA. You don't get the same tax benefits, but a lot of us have IRAs with $1 million sitting in it that isn't really doing much for us. You can take a portion of that and put it to work for you and have those revenues flow directly back into your IRA by taking a small portion of it out. Numerous ways to participate, and different depending on your tax needs. There's all kinds of different scenarios that we can fit it into someone's portfolio. The best way is cash if you have it, and if you have the tax needs, because those are going to have the biggest impact right away.
Super cool. So you were talking about getting made whole in a short time span. I'm not going to mention, short would be, like you said, 18 to 24. That could vary based on the project, understood. But the idea is to get capital back to be your return on capital, quote unquote, made whole fast, and then just keep that interest. Because like you said, if you're still getting your income, then why would you want to get rid of it?
Right.
My question finally, before we kind of close out here, is the tax benefits. Is that only for a couple year period as well?
No, it's the most of it is you can deduct, and that's a great question. I'm glad you brought it up, because we're coming up on roughly 45 days before the end of the year. anyone who participates before December 31st, and we're open on December 31st to the last second you can get a wire in for a reason, is you still get to write it off of this year's ordinary income. 85 to 90%, 85 to 90% of the investment you can write off in year one. The remaining 10% you can amortize over the next few years, or you can amortize the whole thing depending on what your accountant decides is best for you. So there's multiple ways of doing it, but yeah, the bulk of the write-off is in the year that it's invested. So in this case, 2025. And to the other point, what a lot of our partners do is when these wells go online, yes, the revenue generated by them, you are getting a 1099-R for the income. So you're going to be taxed on the income because it's an income producing investment.
Yep.
What a lot of our partners do, and just by way of, simple percentages, 70 to 75% of all of our projects are funded by existing partners because they save money on the front end on their initial transaction with us. Yep. But then to cover the 1099 tax money that they're having to pay out on the oil wells that are generating revenues, they invest in future projects. So we have a very good track record of reinvestment with our partners, and I think that speaks volumes of our company.
Yes.
But some of these oil wells will create your own tax situation that you have to think about for the future and do more. But everybody has a budget. Once you're a partner of ours, you're assigned representative. Their job is to show you every project that we have coming along. And it's your decision whether you participate or not, because everybody has a budget. Everyone has different tax needs. So that's kind of how we're structured. You'll know everything that's going on. And then it's your job to say no or yes. And we're fine with either one. But we're not going to keep anything from you as an investor of ours or a partner of ours. Also, we have a website, and an app. So if your wells are on when they're in production, you can look at a glance on your phone and see what your wells are producing. We send K1s out February 28th of every year for the prior year's investments, so you can write those off and get them to your accountants in time to use the tax benefits.
Nice. None of this was financial advice. Definitely go talk to your CPA. I forgot to mention that, John. I'll mention it for us. And so, yeah, the individual tax strategy and tax plan on that. But that's definitely speaks volume to having reinvestment. So great to hear on that too. I want to, there's a ton more we could talk about. I want to just kind of ask here, what are some of the, in maybe a minute or two here, what are some of the maybe common misunderstandings or FAQs that you hear out there from investors, or just like, I wouldn't invest in oil and gas because of XYZ, type of thing.
Yeah, the red flags to look out for are, number one, there are a lot of good companies out there. There's a lot of bad companies. And I don't even mean bad companies in the way of being crooks. I just mean in the way of being underfunded. You can also, if a company is utilizing a smaller operator that isn't very well backed, something to look out for is, yes, you may have paid in to participate in the wells, but are they going to be able to, in the future, cover any costs, to run those wells? Are they, I don't want to, there's a lot of good mom and pop operators, but there's also, that's usually what you run into is someone who's underfunded in this business. They don't last very long. And that's why, we work with the biggest names in the, I'm not going to name drop. I already did earlier, some of them, but that's who we work with. And so, and a lot of them actually reach out to us to participate with them, which is unheard of in our industry. Most operators want to control 100% of everything. But in several instances, they've reached out to us to see if we'd like to partner with them because it removes some of their capital.
Why do they work with you? Is it because you've been in business for a long time, or?
Well, we've established our name in the field, in Wattenberg Field, and we pay our bills on time, and we're easy to work with. We don't cause any commotion, and we don't disrupt their operations. I'll take partners to the field 3 and 4 times a year so that they can see exactly how their money goes to work for them. But we stay out of the way of the operators because we don't want work to stop. And just like
Right.
if it was a construction zone, if you have a busload of people, showing up, they're going to stop and go, who is that? What are they doing? So we stay completely out of their way. And we've got a good track record up there and a lot of good business relationships. And that's how these have kind of come to fruition lately. So we're very proud of that fact too.
Cool. So mostly underfunded ones and smaller ones are one of the biggest ones.
Vertical wells. There's good and bad in all of it, but you want to watch out for exploratory drilling. You want to watch out. I mean, if they're upfront about it and you know what you're getting yourself into, then fine. If you're a risk taker and a gambler and they say, hey, this is risky, we're wildcatting, we're going purely off seismic, we don't have any wells nearby, but this could be the next mother lode, you can take that risk if you want to. But if you want to have a better chance of success, you drill in with a known operator with a good track record in a known proven field, and horizontal is the way to go.
Cool. Awesome. I wish we had more time. I definitely got more questions. I know I got to let you go here. John, thanks for being here. You mentioned you have the website and even having the app to go and check out the wells. I thought it was really cool that if your partners, capital partners, investors, or you take them out to the field to go check out that as well, because it's backed by real estate.
Yeah,
oil and gas is real estate.
There's no better way, and that's why I do it. Is everybody has these preconceived notions of how it all works, and there's no better way outside of building something in real estate to see your money go to work for you. And so what I do is fly the partners out. I'll usually do 4 trips a year, avoid winter in Denver, obviously. But we fly the partners in on Friday night, meet for breakfast, hop on a bus. I used to do it in Suburbans, but now we cram 25 to 30 people. And all the partners get to meet each other. So now I get to meet them and spend the day with them. But I show them every aspect, from clearing a pad, the rig, the completion crews, and then we finish the day by walking around and everything on a production facility, from where the oil and gas comes out of the wellhead to where it goes into the sales lines. And then everybody eats really well on these trips, so it's a good time.
Awesome. Mention your site where people can find you, John.
Yeah, if you're interested or you have any questions whatsoever, our website is www.gulfcoastwestern. Almost all the letters in the alphabet, but it's GulfCoastWestern.com. Man, I need to take a break.
Nice.
GulfCoastWestern.com. Go to info and just fill in your information, your contact information, and I'll have one of my account reps reach out to you.
Sounds good. I'll make sure those are in the show notes too, man. Go to the show notes, check it out, just where John mentioned, and fill out the form if you're interested. I was checking that out too. There's some more resources and on there too. So there's a lot to deep dive on here. John, thanks so much for being on the show. I appreciated this. It was good to get this brought to the listeners, and I gotta go learn some more. I want to add this to my portfolio too.
All right, that sounds great. We'll do a follow-up show later.
Sounds good. See you, brother. Thank you.
All right. Have a great day. Thank you.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.